Right now, while most investors are watching stock tickers and crypto charts, a much quieter signal is moving through the gold and silver markets. One that almost nobody is talking about. It's not a headline, it's not breaking news, it's a pattern that historically has only appeared before major currency crises. And if this pattern is confirming what it appears to be confirming, then what happens next to the US dollar may not be gradual. It may not be slow. By the end of this video, you will understand exactly what this signal is, why central banks are already positioning around it, and why the next 12 months could look nothing like the last decade. Stay with us, because this changes everything. Welcome back to Precious Metals Intelligence, the channel dedicated to helping serious investors, professionals, and decision makers understand the strategic economic forces shaping the future of money. If you're new here, consider joining our community of thoughtful, forward-looking viewers who prefer substance over noise. And before we begin, we'd genuinely love to know, where in the world are you watching from today? Drop it in the comments. It always amazes us how global this conversation has become. Now, let's get into it. Most people watching the financial news today are focused on the wrong screen. They are watching stock prices jump up and down. They are watching the latest headlines about technology companies and their earnings. They are watching interest rate announcements, waiting for the next small move from central banks. This is where almost all public attention goes. It is loud, it is fast, it fills every news channel and every phone notification. But somewhere quieter, something else has been happening. For those who study money carefully, not day traders, not casual investors, but people who track the deeper currents beneath the surface, gold and silver have been sending a very different kind of message. It is not loud. It does not arrive as breaking news. It does not trend on social media. It simply shows up slowly in the price charts for those who know where to look. For months, gold and silver moved sideways. They went through a long stretch where prices barely changed. Many casual observers assumed this meant nothing important was happening. They lost interest. Some even said gold and silver were finished as an investment, that the excitement was over. But history tells a different story about moments like this. Time and again, in past decades, gold and silver have gone through long, quiet periods where nothing seems to be happening, right before a much larger move begins. These quiet periods are not signs of weakness. They are often signs of preparation. Big investors, and sometimes entire governments, use these calm periods to build their positions slowly, without drawing attention to themselves. They buy a little today, a little tomorrow, without causing a sudden price spike that would alert everyone else. Then, without much warning, the pattern breaks. Prices move quickly. And by the time most people notice, the early stage of the move is already over. This is what makes gold and silver different from many other assets. They are not driven only by excitement or fear in the short term. Over the long run, they are driven by something deeper. Trust. Trust in currency. Trust in government promises. Trust that the money in someone's bank account will still be worth something meaningful next year, and the year after that. When that trust weakens, gold and silver often respond before anything else does. They move quietly at first, almost like a warning whisper, long before the wider public understands what is happening. This is why so many experienced analysts pay close attention to these markets, even when the mainstream financial world calls them boring or old-fashioned. And this is exactly why what is happening right now deserves attention. After a long period of consolidation, both gold and silver have shown early signs of a shift. Not a dramatic headline-making event, not a sudden crash or a sudden spike, just a shift, a change in behavior that, on its own, might seem small, but when placed next to history, this kind of shift has often marked the beginning of something much bigger. The challenge is that most people are not trained to notice this kind of signal. They are used to watching for loud events, a stock market crash, a company scandal, a surprise interest rate hike. They are not used to watching for quiet ones. And quiet signals, by their very nature, are the ones that get ignored the longest. This is not simply a story about gold and silver prices going up or down. It is a story about what those prices are trying to say about the financial system underneath them. Prices in these markets do not move only because of local supply and demand. They move because of something much larger. Questions about currency, questions about debt, and questions about trust in the entire system that modern economies are built on. For business professionals, entrepreneurs, and anyone responsible for making long-term financial decisions, this distinction matters. A short-term trader might only care about tomorrow's price, but someone thinking strategically, someone planning years ahead, needs to understand what these quiet signals are really pointing toward. And that brings the story to its next chapter. Because gold and silver prices do not move in isolation. Behind them, a much larger group of players has already started paying close attention. Central banks, sovereign wealth funds, institutions with resources far beyond the average investor. They are not waiting for the headlines either. Long before ordinary investors ever hear about a shift in the financial system, a much smaller group of players has usually already made their move. These are not hedge fund managers chasing quick profits. They are not retail traders watching charts on their phones. They are central banks, the institutions responsible for managing entire national currencies. And when these institutions start changing their behavior, it rarely happens by accident. For years, most people assumed that central banks simply held their reserves in a handful of major currencies and left them there. It seemed stable. It seemed safe. It seemed like something that would never really change. But behind closed doors, a quieter shift has been taking place. Many central banks, especially those managing large reserves, have been steadily increasing how much gold they hold. This is not a small or symbolic gesture. It is a deliberate, calculated decision made by people whose entire job is to protect their nation's financial stability. These are not people who act on emotion or speculation. They act on analysis, on long-term planning, and on risk management. When an institution like this decides to hold more gold, it usually means one thing. They are preparing for uncertainty they already see coming. Why would they do this? The simplest answer is trust, or more specifically, a lack of it. A central bank's job is to protect the value of its country's money and its reserves. If leaders at these institutions begin to worry that a major global currency might weaken over time, they do not wait for that weakness to become obvious to everyone else. They begin adjusting their holdings early, quietly and gradually, long before the public catches on. This kind of behavior has shown up again and again throughout history. Central banks are often described as slow-moving and cautious, but that caution is exactly why their actions matter so much. They do not chase trends, they do not panic. When they change direction, it is usually because something deeper has convinced them that change is necessary. And right now, many of these institutions have been doing exactly that, adding gold to their reserves at a pace not seen in years. Some nations that had not meaningfully increased their gold holdings in over a decade have recently returned to the market. This is a significant change in behavior, and it did not happen without reason. To understand why, it helps to look at the bigger picture these institutions are watching. Government debt levels across many major economies have grown to levels rarely seen outside of wartime. Interest payments on that debt have grown larger and larger, consuming a bigger share of national budgets every year. For any organization responsible for long-term financial planning, this is not a minor detail. It is a warning sign. Central banks understand something that many everyday investors overlook. Currencies are only as strong as the trust placed in the governments that issue them. When a government's debt grows faster than its economy, that trust can slowly erode. And once major institutions begin acting on that concern, they rarely announce it publicly ahead of time. Instead, their actions speak first. This is why gold accumulation by central banks is often described as a leading indicator rather than a lagging one. It does not tell people what has already happened. It hints at what these institutions expect to happen next. And historically, when many central banks move in the same direction at the same time, it has often preceded much larger shifts in the broader financial system. For business professionals and long-term planners, this detail carries real weight. It is one thing to watch retail investors get excited about a rising price. It is another thing entirely to watch cautious, data-driven institutions, the kind that rarely make bold moves, quietly repositioning their reserves. That kind of movement does not happen because of short-term speculation. It happens because of long-term concern. And this concern does not exist in isolation. It connects directly to a much larger issue sitting underneath the entire global financial system, one that has been building for decades and is now becoming harder to ignore. That issue is debt. Specifically, the debt carried by the very governments whose currencies the world still depends on. To understand why central banks are moving the way they are, it becomes necessary to look closer at that debt itself, how it built up, why it matters so much right now, and why so many economists believe this cycle may look different from anything the modern financial system has faced before. To understand why gold and silver are stirring, it helps to step back from the metals themselves and look at something far less exciting on the surface: government debt. It sounds like a dry topic, something reserved for economists and policy analysts, but debt is the foundation underneath every modern currency, and when that foundation shifts, everything built on top of it eventually feels the pressure. This is not a new idea. It is one of the oldest lessons in economic history, yet it is also one of the most consistently ignored, because debt problems rarely feel urgent until the moment they suddenly do. Here's the simple version of how it works. Modern currencies are not backed by gold anymore. They are backed by trust. Trust in the government that issues them, and trust in that government's ability to manage its finances responsibly. When a country borrows money, it makes a promise to pay that money back, with interest, over time. As long as the country's economy grows fast enough to support that debt, the system holds together smoothly. The trouble begins when debt grows faster than the economy meant to support it. This is exactly the situation many major economies find themselves in today. Government debt levels have climbed to sizes rarely seen outside of major wars, and it is not just the size of the debt that concerns analysts, it is the cost of maintaining it. As interest rates have moved higher in recent years, the cost of simply paying interest on existing debt has grown sharply. In some countries, interest payments alone now consume a share of the national budget that once would have seemed unthinkable. This creates a difficult and uncomfortable cycle. Governments must either raise taxes, cut spending, or borrow even more money just to keep up with their existing obligations. Each of these paths carries political and economic costs. None of them are easy. And history shows that governments facing this kind of pressure often choose the path that feels least painful in the short term, even when it creates larger problems down the road. That path, more often than not, involves some form of currency devaluation. Rather than openly admitting a debt cannot be repaid in full, governments can quietly let their currency lose value over time. This makes debts easier to pay back in nominal terms, but it also means every unit of that currency buys less than it used to. It is a slow, often unspoken form of financial adjustment, one that rarely gets announced but shows up gradually in the cost of everyday goods and services. This is not a theory. It has happened repeatedly throughout history, in different countries, under different governments, across different centuries. Whenever debt burdens became too heavy to manage through normal means, currencies eventually absorbed the pressure. Some episodes were gradual, others moved quickly once confidence began to break down, but the underlying pattern has remained strikingly consistent. This is also precisely the environment in which gold and silver have historically regained their importance. When paper promises begin to look shakier, physical assets that cannot be created out of thin air tend to attract renewed attention. Gold and silver cannot be printed by a central bank. Their supply cannot be increased overnight to solve a budget problem. This is exactly why, throughout history, they have served as a kind of financial anchor during periods when trust in paper currency began to weaken. What makes the current situation particularly notable is scale. The debt levels being discussed today are not simply large by historical standards. In many cases, they are the largest ever recorded during peacetime. This is not a fringe or exaggerated claim. It is widely acknowledged by economists across very different political and philosophical viewpoints. The disagreement is rarely about whether the debt is a problem. The disagreement is about how and when that problem eventually gets resolved. For business professionals and long-term planners, this is not simply an abstract economic debate. Currency stability affects borrowing costs, international trade, long-term contracts, and strategic planning of every kind. A business that assumes stable currency conditions may find itself unprepared if those conditions shift more quickly than expected. This is the deeper backdrop behind everything discussed so far. The quiet movement in gold and silver prices, and the steady accumulation of gold by central banks around the world. Neither of these signals exists in isolation. Both are responses, in different ways, to the same underlying pressure building beneath the financial system. The next question becomes harder to avoid. If this pattern continues to unfold the way history suggests it might, what actually happens next? And more importantly, what does it mean for the people trying to plan their financial future in the middle of it? Every financial transition follows a familiar rhythm, even if most people never notice it until it is too late. First comes the quiet stage, the one already described. Prices moving sideways, institutions repositioning slowly, central banks adjusting their reserves without making headlines. And this stage can last for months, sometimes years. It tests patience more than anything else. Then comes a second stage. This is the stage where the pattern begins to confirm itself. Prices start moving with more energy. The slow, steady climb becomes harder to ignore. More voices begin talking about it. More attention starts to build. This is usually the point where casual observers finally begin to notice something is happening, right as the early, quieter opportunity has already passed. History suggests this second stage often comes with real volatility. Prices do not move in a smooth, predictable line. They move in sharp bursts, followed by pullbacks that can feel unsettling even to experienced investors. A sudden rise might be followed by a drop that shakes confidence. Then another rise follows, often stronger than the last. This back and forth pattern is not a sign that something is broken. It is simply how markets behave when large amounts of capital are shifting position at the same time. This is also the stage where most people make their biggest mistakes. When prices rise quickly, emotion takes over. Some investors rush in late, driven by excitement rather than understanding. Others, who may have been holding patiently for a long time, panic during a pullback and sell at exactly the wrong moment right before the next stage of the move begins. This emotional whiplash has repeated itself throughout financial history in nearly every major transition. The pattern is rarely about the asset itself. It is about human behavior under pressure. This is why discipline matters more than excitement during these periods. Analysts who study these cycles closely often repeat the same advice. Avoid excessive borrowing to chase bigger gains, because leverage can turn a temporary dip into a permanent loss. Avoid making decisions based on short-term price swings alone. And most importantly, understand the difference between short-term noise and the long-term direction the underlying signal is pointing toward. For business professionals and entrepreneurs, the stakes here extend beyond simple investing. Currency instability does not only affect portfolios, it affects the cost of borrowing, the pricing of contracts, international business relationships, and long-term planning of every kind. A leader who understands these shifts early has time to prepare. A leader who waits until the shift becomes common knowledge often finds themselves reacting rather than planning. This is the real danger hiding inside this entire story. It is not that gold and silver might rise sharply. It is that the underlying reason behind that rise, a weakening currency system built on unsustainable debt, could affect far more than just one corner of the financial world. It could touch savings, purchasing power, and long-term financial security for people who never paid attention to any of these warning signs in the first place. History does not move in straight lines, and it rarely announces itself clearly in advance. But it does leave patterns. Quiet periods followed by confirmation. Confirmation followed by volatility. Volatility followed eventually by a new understanding of what the underlying asset was really signaling all along. The question now is not whether this pattern has appeared before. It clearly has, many times across many decades. The real question is what someone does with this understanding while there is still time to think clearly, rather than react emotionally once the shift becomes impossible to ignore. And that brings this story to its final and most important part. Not just what this signal means, but what someone might reasonably do with that knowledge, and why the choices made in the coming months could matter far more than they appear to right now.